Hello there, my name is Conrad Kluge and this is the Kluge Wealth Advisory Group Client Connect video for May 2026. Now, before we get into anything else here, we're going to cover off a few things today. Number one, we're going to do a quick back to the basics on wills and powers of attorney. We're going to cover off a monthly portfolio and market review. And then we're going to answer a couple of your frequently asked questions about what has happened over the course of the month of April and May, as well as some questions we saw that were surrounding interest rates and such. Now, before we get into anything else, just a couple of quick reminders. The first is that we did a great podcast with Fidelity Investments earlier in the month on AI, what it is, the recent developments in artificial intelligence, and how it can be applicable to day-to-day life. And then secondly, I always want to remind everybody that we are here to provide a comprehensive financial solution, meaning that we're here to answer questions around how do I use my portfolio to generate retirement income, how do I ensure that my will and estate planning is in alignment with my wishes, and finally answering questions perhaps around educational planning. For instance, how do I ensure that my children or grandchildren have sufficient assets to pursue educational opportunities? So if you have questions on any of this, including the podcast or any of the topics that we're hitting here today over the course of our conversation, please pick up the phone, email us, reach out. We're here to help and happy to answer any questions you may have. In thinking about estate planning, there are really two fundamental documents that we have to think of, your will and your power of attorney. And when we really look at a big picture level, there's a lot of similarities between the two. In fact, you could almost describe both of them with an old phrase that I got from a great estate attorney, which is that when you have a will, you have a say. So ultimately, you can break both a will and a power of attorney down into two component parts. With a will, the first component is your wishes for your property and finances when you've passed away. And the second component is your assignment of someone to get the job done, your executor. Now, with a power of attorney, this applies when you're alive but unable to manage your own finances. So it is your direction for what to do with your property and finances while you're not capable of taking care of them, as well as the assignment of a person to get the job done, and that's known as an attorney. Now, when we think about the role of an attorney or an executor, there's a lot of broad similarities. And when you're thinking about who you would want to appoint there, you have to think really of a number of things. Number one, you have to think of someone that's capable and competent. The second is this person's got to have the time to do it. These are very time-intensive roles. They have to be willing to do it. And as well, ideally, you would want them to be resident in the same province that you are. Now, again, covering off on a very high level, one of the most important things that I would want to highlight, and something that we do see when we're doing planning work for clients on a regular basis, is you do want to ensure that you're reviewing your wills and power of attorney every 5 to 10 years to ensure that they reflect your wishes and that the people that you've named for those executor or power of attorney roles still meet those requirements that I just spoke about. So if you have any questions on this, or there's anything on your mind in regards to will and estate planning, please be in touch. We're happy to answer your questions and get you the information that you need. Thank you. In terms of a monthly portfolio and market update, it's a pretty simple story for the course of May. As you can see here from this chart, which we took from Refinitiv, of the S&P 500, markets had a very strong month, and in the US especially so, driven by the technology sector, which is a large part of the index. Now, if we take a look at other parts of the market, we did see that key long-term interest rates, such as the US 10-year yield, did rise somewhat, as well as market participants did begin to think that there's some potential that the US Federal Reserve may hike interest rates later this year, although that's far from certain, and there's a lot that can happen between now and then. In terms of commodities, we saw that commodity prices were generally flat to slightly down over the course of the month, if you're looking at the Bloomberg Commodity Index, and we did see a big sell-off in the price of oil. Now, in terms of portfolios, it's not going to be a surprise for me to tell you that May was a very strong month for all models, and that would be led by the allocations to the technology, industrial, and consumer discretionary sectors. And over the course of May as well, we did take some profits, that have occurred since the bottom in March 30th. We did have a number of positions that did accumulate a disproportionate amount of return. And so we did make sure we trimmed them back to ensure that we have assets available to take advantage of any future opportunities. Now, if you have any questions in the portfolio, again, please reach out, give us a call. We're here to help. So looking at this month's frequently asked questions, I want to start out by providing the high-level answers to those questions, and then we'll get into more depth in the next clips. So the first question we saw a lot of, which was, a lot has changed my portfolio since the end of March. What happened and why? Well, as we discussed earlier, we did see very, very strong performance across all models over the course of April and May. And the why is really coming down to the fact is that corporate earnings are very strong. And we do know that if corporate earnings are up, the most natural thing in the world is that stock prices should go up. The second group of questions that we saw over the course of the month was a lot of questions around interest rates. And so the bottom line answers on this one really is that yes, the US key interest rates such as the US 10-year yield have risen, but not to levels that should cause any concern. And the second answer really comes down to the fact is that, yeah, there are some market participants that are now starting to price in the idea that potentially the US Federal Reserve will raise rates early next year. However, I do want to emphasize that these rate odds change quite a bit, and there's a lot of data between now and then. So we just want something that is something we definitely want to monitor, but it's not something that is locked in per se. So in the next segments, we'll get into a little bit more detail, but hopefully this gives you a good high-level overview of what we're going to be talking about. One of the most common questions we saw over the course of May was, what has just happened since late March and why? Well, the what is very straightforward. We've experienced a 9-month rally that has carried key indices such as the S&P 500 and NASDAQ to new all-time highs. The why did it happen? It's a bit more of a tough question, but I think I can describe a two-step process here that really nails what happened. So there are two dynamics that are at play here. The first is that the market, when the Iran conflict began to price in and began to recognize in price the disruptions that are going to occur due to the loss of oil exports and due to the loss of the other exports such as fertilizer, liquefied natural gas, helium, etc., that all flow through the Straits of Hormuz. So, during the course of February and early March, we did see the markets come down in price about 10% from top to bottom. Now, in price, that's a pretty normal correction, and we would expect over the course of any year to see 1 to 2 10% corrections. So that doesn't seem like it's pricing anything particularly severe or anything ongoing, but we also have to combine it with a second feature here. The other thing that was going on at the same time is that bottom-up earnings estimates from analysts were rising rapidly and had been doing so for some time. So we were walking into a situation where the stock market had dropped about 10%, and prior to earnings season, earnings estimates had risen 10%. And so when you combine those two things together, what you saw was about a 20% valuation drop of key market indices such as the S&P 500. Now, if you take a look at a slide here, we're going to show you that drop in valuation is approximately what happened in April of 2025 with the tariff disruption fears. So this was pricing a very, very severe potential outcome. And we don't want to understate the amount of valuation change that happened here. And again, we can put another slide up here. This just illustrates in more visually here the path of earnings expectations from analysts. So you can see that this is something that continued to rise throughout the year and into March. Now, by the time we get into late March, really what happened is the markets begin to recognize that the Iran conflict is going to reach a negotiated solution at some point in the relatively near future. Now, that hasn't occurred as of the date of filming today, but again, markets are looking forward out 9, 12, 18 months and saying the disruption that we're seeing is temporary. Therefore, I'm going to start paying more attention to earnings. And as we went through earnings season, it was very clear that those analyst estimates for a 10% increase in earnings were far too low, and that really the earnings growth rate was more like 17% if you look at FactSet data. So, the market's attention shifted from the winding down Iran conflict situation to a rising earnings situation, and naturally, markets went up. Now, the other way we can look at this is through a behavioral lens, right? Ultimately, we just have to think about it this way, is that, during the opening days of the Iran conflict, there were a lot of fears about what could happen, and that led investors to get too pessimistic. And then once they realized their worst fears weren't going to come true, then they repriced the markets higher to reflect really what is the most likely outcome. Now, this is not saying that things, new information wouldn't cause the markets to go up or down further. However, we just want to take a look at the dynamics of what happened here, because it's not a straightforward, situation where markets came down substantially. It was very clear, and then they bounced off a low. It was this two-step combination of rising earnings and falling price and rising earnings. So again, if you have questions on this, please reach out. Happy to discuss it further and in more detail if you wish. And we'll move on to our second question. Thank you. So another group of questions that we saw over the course of our client conversations in May revolved around interest rates. There are two kind of key questions that I'm rolling together here in this clip. Right? The first question is around the possibility of seeing interest rate hikes later this year. And the second question is about, is there a danger sign being flashed by the increase in the US 10-year bond yield? So with respect to the first question around the possibility of interest rate hikes by the Federal Reserve later this year, I mean, the answer to that one is it's really hard to tell. We know that rate hike prediction markets frequently change the odds about whether the Federal Reserve is going to act, to raise rates, to remain neutral, or to cut rates. And there's a lot of data that's going to come out between now and then. And importantly, we have a new Fed chair. So this is something we've got to keep in mind, is that that these type of rate hike markets change frequently, and just because they're saying that interest rates may rise early in 2027 doesn't mean that that's locked in. Now, what impact would that have if they did raise rates? That is also hard to tell. All things equal, interest rates going, short-term interest rates going up may exert a negative influence on the stock market because higher interest rates provide competition for capital, right? Do you invest your money in safe bonds at a higher rate, or do you invest your money in a somewhat uncertain stock market? Now, the problem is that all things are never equal. If you see earnings growth continue at the momentum that you've seen, the stock market may not care about slightly higher interest rates because the earnings yield on stocks may be going up much, much faster. So this is a very tough question to answer, but it's one that I have to leave off and just saying that we are monitoring overall conditions and ensuring that we are sticking with our risk management disciplines as we take a look at all these issues. Now, the second question we got a lot of, and as well as a few clients sending in articles and mentioning specific things that they had read, was there's a number of articles out on major media outlets just linking, sort of making a direct link between rising US 10-year bond yields and some sort of imminent crash in the US stock market. Now, the first thing we want to acknowledge is that yes, if longer term interest rates are going up, that can definitely indicate that the bond market is starting to bake in higher inflation and higher rates going forward, and that is going to present, that much more than short-term rates is going to present a serious headwind to US equity and global equity markets writ large. The problem in this situation is that this is just not an if-then function, right? And if you present it as an if-then function, you're oversimplifying the situation, right? Given the current situation, there's a number of explanations that I can come up with for why, for instance, the US 10-year rate rose as high as 4.7% before pulling back to about 4.4% over the course of May. And I think that the bottom line is that, first of all, is that you have a new Federal Reserve chair that's coming into seat, and no matter whether this guy is excellent, bad, indifferent, at the end of the day, with Warsh coming in, you've got a new sheriff in town, and it's always going to create uncertainty, and uncertainty creates sellers. Sellers lead to higher prices, and again, in bonds, higher prices is higher yields. So that just may have to do with this changeover at the Federal Reserve. It may also have to do with concerns about U.S. debt sustainability and long-term inflation. That, of course, is the bear case or the doomer case. That could certainly be true. The other explanation I can come up with is the fact is that the bond market is starting to price higher long-term growth. If U.S. growth is picking up and corporate earnings are obviously a sign that something is happening in the economy that's very, very positive, then it makes no sense that interest rates would stay as low as they were previously. So there should be some pickup in interest rates because demand for capital is going up. So there are a lot of explanations, and which one you choose has a huge impact on the viewpoint that you take. Now, I personally believe that it's probably a combination of new Fed chair, a pickup in the U.S. economy as evidenced by surging earnings, and then there is, of course, you always have to price some probability that oil stays higher for longer and disrupts the world economy. But I really think that it's probably mostly the first two and a little bit of the last one. So again, this is something that we have to closely monitor, but it's not a simple if-then situation, and that really goes for a lot of things with capital markets. Is that if A led to B, led to C, led to D, this would be very, very easy business. But the reality is that A leads to B and then Z comes in and you skip to K. And that's what makes this very, very difficult. So again, always happy to discuss these ideas and these questions, but just wanted to give you some perspective around some of these things that we've seen. And again, if you have questions or you want to get into more detail or have a bit more of a higher level discussion on this or more detailed discussion on this, just pick up the phone, reach for us on Calendly, email. We're here to help, and we're here to give you the the advice and perspective that you need.